Good afternoon, everyone. We will start the session in a few minutes. Just take a few minutes for everybody to join. Good afternoon, everyone. We will just take a couple of minutes to start. It's 4:01. We should start the session by 4:03. Good afternoon, everyone. I am Prabhudev. I am your host for today. I welcome you all to yet another session of the knowledge series on ASK products. Today, we have with us Mr. Chetan Thacker, who is the portfolio manager for the emerging opportunities portfolio. Chetan Thacker has been with us since 2015 and has an overall experience of more than 15 years. His sector research expertise lies in sectors like agriculture, chemicals, metals, mining, and the mid-cap space. Today, we are having this seminar on the emerging opportunities portfolio, wherein there would be a question answer session at the end, and where we will curate the questions raised by all of you and try to answer to the best of our capabilities. With no further ado, I welcome Chetan and request him to take the podium.
Thank you, Prabhudev. Thank you so much. Good evening, everyone. Thank you for joining us today for this webinar. The way we structured this is we'll first briefly take you through the macro backdrop in which we are currently operating, what we expect going forward on the macro front. We'll then follow that up with how the portfolio is positioned at this point of time and how do we see the portfolio earnings to pan out going forward. Followed that with a Q&A session as Prabhu has highlighted. In the meantime, as we are going through the webinar, feel free to post any questions you may have in the chat box and you will take all of them up in the Q&A piece. So just before we begin, we'll just briefly touch upon our investment philosophy on which the EOP strategy is based and all the other strategies from the ASK house are based. So our investment philosophy is essentially based on identifying high quality businesses run by high quality managements with a large size of opportunity, which in turn essentially means that these companies can deliver a compounded earnings growth over the length of time. Our belief is that you need marriage of all these factors together in order to deliver returns over a longer period of time. And all of these aspects are extremely critical. And the backdrop of the ever increasing volatility in the environment, our belief is that it's only quality of management with a good quality of business that can distinguish itself in the marketplace and deliver longer term earnings growth and health longer term returns for all concerned and all shareholders. So what we essentially look at while looking at the three pieces together is that we look at entities where there is greater certainty of earnings and not just mere quantum of earnings growth. We like certain earnings growth as compared to a very large quantum of earnings growth but with a high degree of uncertainty. We like companies wherein there is superior and consistent quality of earnings growth. When we say quality of earnings growth, it essentially means capital efficiency of those businesses, and those earnings should essentially come while improving the quality of the business itself and quality of the return ratios itself, as opposed to mere quantum of earnings growth. We believe that if we are able to identify such high quality entities and buy them at a reasonable price, that is our objective, as opposed to buying inferior quality businesses at arithmetical cheapness, because these are the key ingredients that are needed to compound returns over a longer period of time. So we essentially look at buying high quality businesses at reasonable prices. Moving on to the backdrop, and just to begin with the global backdrop. So I think CY22 has been an extremely challenging year, not only from an Indian point of view, but also globally. There were certain factors, decadal factors, which have reversed in CY22. The biggest of them, of course, is inflation. And inflation in turn has meant that cost of capital globally, after a length of time, has started to inch up and has inched up very rapidly. Inflation essentially has two parts to it. The first part, which was initially believed at the time of COVID, was that a large degree of inflation, which we were witnessing at that point of time, was largely supply driven, and there were supply bottlenecks because of lockdowns that were there in certain parts of the world. Obviously, all the efforts were not coordinated, so you had certain parts which were still under lockdown, certain parts were open, and it was essentially leading to supply bottlenecks and constraints, which was driving inflation to some degree. On this backdrop, what essentially was happening was you've also witnessed a very large fiscal expansion, particularly in the developed world, where most of the governments went out there to support their population incomes as they enforced lockdowns, which in turn meant that there was a larger amount of money that was being pumped into the system in order to protect the population from the adverse effects of lockdowns. In this backdrop, you had a complicated supply chain scenario, given that a lot of supply chain moves through China. China was or continued for a length of time till probably the end of this year. They continued to follow the zero COVID policy, which essentially meant supply chains globally were in for a shock and were essentially dealing with a situation wherein certain pockets of the supply chain were not functioning, or you had a situation where availability of raw material itself was a challenge. So that is the backdrop of as we entered CY22. As we were entering CY22, there was a belief that as COVID was waning down globally, most of the larger countries had essentially opened up. You will be in a situation where there will be significant amount of demand. The supply bottlenecks essentially meant that commodity prices too were higher, and that was largely because of the premium that was placed to availability of those commodities. This in turn meant that most of the companies essentially piled up on inventories with the hope that demand will be robust as everything opens up. People went in to lock in raw material supplies even at higher price because the anticipation was with the unlock, the demand will essentially come and there will be some amount of pent up demand that we will witness across the board. What played out eventually was quite contrary to the belief which everyone had sitting in January of 2022. The first big shock obviously was the war between Russia and Ukraine. What that essentially did was it again propelled energy prices higher for a certain period of time. Coupled with that, we also saw pressures which happened on the agri commodity side because there is a large degree of agri trade and Ukraine and Russia both put together were large suppliers, particularly of wheat and other oil seeds into the world, and that essentially came under question and under supply issues as that war raged and leading to increase in prices for both energy and agri commodities. So that in turn meant that inflation, contrary to the belief at that point of time that it is driven by just supply bottlenecks, and as things open up, inflation starts to ebb. We were then witnessing a phenomenon where obviously supply chain was taking its own time to ease, while excess liquidity which was pumped into the system was creating inflation of its own, and which meant that most of the central banks across the world had to essentially react because they wanted to control inflation, and which essentially meant a very sharp increase on cost of capital. It was obviously led by the US Fed, and we've seen a very sharp rate increase in US Fed, and most of the globe followed because we are witnessing inflation across the board. So inflation essentially became a very big challenge. Further, because of cost of capital itself going up and the fact that war in Europe essentially meant demand destruction in Europe, demand obviously did not pan out as it was anticipated as the unlock happened, which meant that everyone was saddled with high cost inventory, which was sitting on their balance sheet, which would flow through the P&L, putting pressures on margin. Till CY22, a fair degree of the inflationary increases was passed on to the customers. Customers had enough money in their pockets to absorb higher prices. But we were in a situation where that was reaching a point where essentially price increases would eventually start to impact volume growth itself, and which meant that margins came under pressure, and that is what we witnessed as the year progressed. This was additionally complicated by the fact that everyone and everywhere we were running with a record high debt level, while household debt in most places globally was under check. What we have witnessed ever since GFC is debt has kept piling on at the government end, and that on and off essentially becomes an issue. And that was an added complication in this entire scenario. If we look at in that backdrop, what happened to growth in general, what we witnessed is India continued to be the fastest growing economy. Going forward also, it is anticipated that India will be one of the large economies which will be fastest growing. China, while it is unlocked, and we've seen zero COVID policy now being shelved, and the country moving ahead with the unlock as we speak, we expect growth to rebound there, but the quantum of growth will be higher for India. While most of the developed world will essentially deal with a situation where you have cost of capital which goes up, which in turn then starts to impact demand. As we progressed and we moved towards the end of CY22 and beginning of CY23, like we were highlighting, because of inflation becoming more sticky, we have seen a rapid catch-up which has happened on the US Fed rate, and that continues as we speak. People are monitoring very closely on the non-farm payroll data that comes from US, looking at incremental data that comes on consumer and retail spending to probably gauge where the Federal Reserve will essentially go and pause. Our view internally is, while timing of this is extremely difficult, we are no experts in this field, but our sense is at some stage you will hit a rate where the central banks will pause for a point of time till inflation starts to cool off before they shift their focus back to growth. Because in order to ensure long-term growth and sustainability, it is very essential to control inflation, and that is where the focus lies currently as far as all monetary bodies across the world are concerned. As we moved towards the end of CY22 and currently we are starting to see the first signs of easing, particularly of commodity prices, be it energy cost, which have started to cool off because demand has come under question. Supply bottlenecks too have started to ease, which is also leading to some amount of cooling off that we are witnessing in commodity prices. We've seen commodity prices hence correct. Energy in particular has corrected from the highs that we witnessed at the time of the first breakout of the war, which is somewhere in the end of Feb and early part of March. We've essentially seen oil cool off from there with a combination of lower demand and the fact that the Russian supply still continued, and you had those supplies coming to the market, which was most feared as we were sitting in Feb and March. Supply chains, like we were mentioning, started to ease off. It is quite visible on the freight index. Freight index is a good leading indicator to say how the supply bottlenecks have started to ease. From the peak, they are down 88%, and they are probably now close to the pre-pandemic level as far as freight rates are concerned, which points towards cooling off of the supply bottleneck. Further, agri prices also have started to correct a bit as we moved ahead. Like we were mentioning, supplies started to come into the world market, which were anticipated to remain off market, which was fueling some degree of fear that how food price inflation would behave as we moved ahead into the calendar year. So there are essentially some amount of green shoots visible, particularly on the energy side, the agri commodity side, the supply bottleneck side, which were primarily responsible for fueling the first leg of inflation. On the domestic economy front, what this essentially means, and particularly a higher oil price environment, plus the fact that global growth today is under a fair degree of cloud, means that trade deficit is high. We are seeing widening of the trade deficit gap, which in turn puts pressure on the external account of the country. What we've started to witness is after a sharp fall in our forex reserves, there is some amount of recoup of those reserves that has happened. But foreign reserves went down from its peak in July and September of 2021, while we are starting to see some amount of green shoots appear there as well. But this is one data point which we are monitoring very closely because this has implication on where the currency heads eventually and the way the CAD behaves going forward. As far as the biggest risk on the external trade is concerned, oil obviously is the biggest risk. It is an inelastic demand as far as the country is concerned. Higher prices essentially mean that the CAD comes under pressure, and that gap comes under pressure. What we witness in this particular slide is after adjusting for the IT exports, I think after a period of time, we are witnessing the first pressure clearly, and that is coming from the trade imbalance, while IT exports continue to hold their stead. Going forward, the view is, given what is happening globally, compared to where we were at the beginning of the last year, there is some degree of moderation in how the IT spends are expected to happen in terms of dollar currency. While the green shoots on the domestic side are clearly visible when we look at the fast moving indicators, something like GST collection, which is held above 1.4 lakh crore for a period of time now. The PMI indices, both composite and broken down into manufacturing and services, continue to point towards an expansion. We witnessed obviously a fair degree of pent-up demand that happened as we opened up after the Omicron wave. It has continued. Services have added to the party, while manufacturing itself is also coming off and it's adding to the party, and we are still seeing expansion on both the manufacturing and services PMI. Diesel consumption is a good enough indicator how the freight movement is happening and how the movement of goods is happening. That growth is also quite visible, which points towards economic activity picking up pace on the domestic side. Credit growth again has been a good enough indicator. In credit growth, what we want to highlight in particular is the period of COVID was a period where essentially you were witnessing two things happening. Everyone was deleveraging their balance sheet. We saw corporates deleverage their balance sheet. We saw working capital being squeezed, which essentially meant that credit growth suffered as we were in the COVID period. On the hindsight, it strengthened the corporate balance sheet. It strengthened the household balance sheets because that deleveraging essentially meant there is more room to re-leverage as growth starts to pick up. What we've witnessed ever since the unlock has happened, we've witnessed an uptick in credit growth. Credit growth uptick is driven by retail. It is driven by industry credit. It is driven by normalization of working capital. And additionally, some degree of private capex, which continues to flow through. Going forward, our expectation obviously is that you will continue to see revival in domestic growth. So far as the current year is concerned, from a macro point of view, volume growth has been sluggish in the first 3 quarters. Like I was highlighting, because of the volatility in commodity prices, margins also came under pressure. Particularly in the first 2 quarters of this year, we started to see them ease off in Q3, and Q3 largely was a quarter where margins started to improve, while volume still continued to remain a tad bit under the cloud. The expectation here is volume growth starts to recover the way the Rabi season is going. We are keeping our fingers crossed that we don't see any adverse weather events, particularly the heat that we are witnessing at this point of time, which impacts the yield, particularly of wheat and other winter crops. If we sail through this period, our view is that rural balance sheets, which were significantly impacted after the second wave of COVID, they will start their repair journey, and that in turn should start to translate to recovery in demand on the domestic side. So from a more macro point of view on the domestic side, clearly volume growth is something which we expect will start to pick up pace starting towards the end of fourth quarter. It will continue through the first quarter as we look ahead. One key positive that has happened and emerged from the budget is that the government has rightly focused on increasing the capex spend. Government has taken the first step to start the capex cycle itself and accelerate that. So capex was anyways being increased year after year. We are seeing an acceleration on the capex spend. That will not only mean that demand recovers for direct plays to that capex spend, it will also eventually fuels to consumption-led growth. Additionally, from a global point of view, there is a very strong tailwind on manufacturing in India. Government has enacted various steps in the last few years, be it lower corporate tax rate, be it the entire implementation of GST. What we are essentially witnessing is that India is now appearing as a sweet spot where people are looking at India as a destination to move their manufacturing bases. And we are witnessing a good tailwind as far as the entire manufacturing piece is concerned. The government has played a key role in rolling out PLI schemes across the sectors. What these schemes are essentially aimed at doing is, these schemes are essentially aimed at providing a limited time-bound support to industries and companies as they scale up to economies of scale and compete globally as far as the manufacturing opportunity is concerned. Apart from what we were witnessing, which was a shift away from China, I think what this entire energy crisis in Europe means is that a lot of high energy or energy intensive manufacturing also looks for a destination outside of Europe because this will turn out to be a structural problem for Europe. And that is where India also fits the bill. A lot of our companies have European MNCs as their customers, so there is a working relationship there. People want to anyways move a tad bit away from China, which that is where India essentially is well placed to attract these kind of investments. And manufacturing as a sector starts to contribute after a length of time to GDP growth. I think services have always been a torchbearer as far as Indian GDP growth is concerned. And manufacturing is an added piece to that, which will drive growth from a more medium to long-term perspective and clearly help in acceleration of growth rates. As we look ahead, our expectation is with demand coming back, we will be in a situation where capacity utilization will be at a tipping point. You will start to see acceleration on private capex as well. And that will provide an added lever for growth as we move ahead. From a macro perspective on the debt side, like we were highlighting, I think the biggest positive is you have bank balance sheets which are now cleaned up. You have household debt, which is not significantly leveraged. You have a corporate sector, which is not significantly leveraged. The entire initiative of NCLT in order to clear loans very fast, which are bad loans, clearly provides a better visibility on how these assets have to be dealt with, ensuring that these assets change hand as long as they continue to have value in them and do not lead to complete destruction of value, and in turn lead to protection of value of these assets. So there are various reforms which the government has done in the last 4 to 5 years, which has obviously meant that ease of doing business has improved. It has meant that manufacturing has become now a centerpiece of growth. Infra spend has been taken on by the government to push towards ensuring that logistics costs eventually go down. A lot of projects have been rolled out on that front. All in all, it is essentially meant to ensure that India also emerges as a manufacturing base. Cost of manufacturing itself then can compete globally and attract a lot of capital. So on the domestic medium to long-term picture, we think things are completely in place. What is a worry is more near-term. From a near-term point of view, our view is domestic will start to turn the corner as we look ahead, and export will probably do that with a lag. What we witnessed in export across various sectors is we witnessed a cycle of destocking that has happened. It was largely driven by the fact that commodity prices were volatile. After moving up, they've fallen sharply, which has meant that people have resorted to destocking of the channel. At some stage, we will get a restocking phase that will happen even on the export front. And that is where we will start to see recovery happen. While currently all eyes are focused on how demand behaves, particularly as Europe moves out of the winter months, our expectation is that we will start to see revival in demand on the export side as well at some point of time in the calendar year 23. If we look at flows and how flows have behaved, which is a large part of the jigsaw puzzle, we've essentially seen outflows. This is obviously a combination of global cost of capital going up. We've seen US interest rates increase sharply, which has meant that monies have been pulled out of not only our market, but this has been a phenomenon that has played out across various emerging markets as well. And there has been a $17 billion outflow in CY22. What has compensated for that, and which is a more bright spot, is the fact that we are seeing a lot of local money, which is domestic flows, which have essentially held on, particularly the SIP flow, as you can see in this chart, have continued to maintain their momentum and they continue to remain robust. And that has essentially meant that the ownership pattern structurally has started to see change, where we are starting to see ownership increase for both retail owners and domestic mutual funds as compared to FIIs. So FIIs have seen some amount of shave off as far as the ownership of the Indian equities is concerned. We are witnessing financialization of savings. That in turn means that ownership pattern shifts, and there is a higher degree of ownership by the retail sector and domestic MFs, which is also in turn ownership by the retail space itself. Coming to the EOP portfolio, and having shared what we believe we foresee going forward. So what we foresee going forward is clearly acceleration in growth. Our sense is with acceleration in growth, what will benefit is the consumption bit, particularly the discretionary part of the consumption. You have strong tailwinds there, which is essentially to do with the fact that we are witnessing an acceleration of shift from unorganized to organized that continues to play out even as we speak. This is something which started ever since GST was rolled out, and it has kept on accelerating. It also means that there is a play on premiumization. As incomes increase on the domestic side, we will see the premiumization play out, which in turn will mean margins will essentially expand as we move forward, which will lead to operating profits growing faster than revenues as this premiumization story plays out. So that is one pocket where we are overweight today. We are overweight in consumption, particularly on the discretionary end of consumption. Within financials, while we are equi-weighted close to what the benchmark weight is, the composition is very different. We have a higher weight on the NBFC side and some degree of higher weight on the insurance side. And we are placed there. We continue to remain focused on retail lending. We continue to remain focused on retailization as a theme. And we believe that as the incomes go up, this is one portion which will benefit not only on the lending front, it will also benefit on the protection front, where there is under-penetration today, be it both general and life insurance. Manufacturing, which we believe is the center stage, and that is where we are also overweight. We believe manufacturing is an added tailwind for the country from a more medium to long-term perspective. And that is a pocket which will witness acceleration in earnings. And that is why we remain overweight in that particular pocket as well. Chemicals similarly stand out there. This is one area where we were in any case witnessing a shift away from China. Just to give some perspective there, the Indian chemical industry size is today in the range of 170 to 180, $85 billion. Chinese exports are to a similar tune, with their chemical space being closer to $1 trillion, which essentially means that even if a large part of the incremental global growth of the chemical space, which essentially grows at 2 to 3%, also moves to India, it is a large enough opportunity for Indian companies. We are continuing to see capexes that continue to happen despite a near-term volatility on the outlook on volume growth on the chemical space. These entities have gone ahead and continued with their capexes. This is essentially a reason of higher inquiries that they are witnessing from their customers, wherein the customers are looking at an alternate source away from China and now even from Europe, particularly on the energy intensive part of the chemical manufacturing. So this is another pocket where we believe that there will be a longer term growth that will happen from a more medium to long term perspective. The tailwinds are clearly there. Looking at how the portfolio is positioned, this essentially gives a snapshot. Assuming that the EOP portfolio is just one stock, what we witness here is that this portfolio has an ROC which is at 26% for FY23. 24, obviously, that expands to 30%. This compares with the benchmark ROC of anywhere between 15 to 16%. So there is significantly higher degree of quality of names in the portfolio. Similarly, on EPS growth, while FY23 had an advantage of a benign base, because of which we see a 26% growth, our belief is that now with acceleration in volume growth in FY24 and normalization of margins, we believe earnings will accelerate in FY24 for the portfolio as a whole. This 30% growth compares again with the benchmark growth number on earnings front in the range of 14 to 15%. So this is a portfolio which is constructed of superior quality names with superior earnings delivery. And that is what we anticipate for this portfolio going forward. FY23 is largely done. We just have a quarter to go. So while earnings have grown at 25-26%, we have obviously witnessed pressure on performance. That means essentially that the portfolio has become relatively more attractive. This is a snapshot of the operating profit growth that we have witnessed in the current quarter, which is Q3. The EOP portfolio has witnessed operating profit growth of 22%, while the Nifty 50 benchmark has witnessed operating profit growth of 12%. For FY23, like I was highlighting, the benchmark growth is 14, while on the operating profit front, while the EOP portfolio is expected to deliver an operating profit growth of 21%. That accelerates as we move into FY24 and beyond, even into 25 numbers. This is the performance snapshot for the EOP portfolio. What you essentially see here is the fact that where we have witnessed pressure is clearly the last 1 year, which is the current fiscal year. We have witnessed a negative performance. This is despite what we are seeing in terms of earnings growth for the portfolio. A large degree of this underperformance is driven by our financial exposure, and hence I will spend some time there as to what has happened on that space. Given that we were exposed to NBFCs, what essentially that means in a rising interest rate scenario is that the cost and the impact of interest rate increases first comes to NBFCs. Banks, on the other hand, are positively impacted because they see repricing of their advances to begin with, while deposit increases or increase in interest rates or cost of funds happens with a lag. We've essentially started to witness that post-November. So if you would have noticed, the deposit rates have started to accelerate post-November. And that is a catch-up that we believe will play through as we move forward. Additionally, I think on the provisions front, very clearly banks were sitting on a very benign base, which meant that credit cost was lower than normal for this fiscal year. As we move ahead, we believe there will be normalization in credit cost as we look ahead. Coupled with this, like I was highlighting, you had acceleration in loan growth itself. This was driven by three factors. People moving away from the CP and CD market because of rate repricing, which happens faster in those markets, which meant that banks' rates were typically lower than what the CP CD rates were, and that meant some degree of credit growth flowing back to the banking system. There was obviously an increase in working capital demand as we witnessed people piling on inventories to begin with. People had run down a lot of those working capitals in COVID and tightened their balance sheet. So there was an expansion on working capital demand, which has played out. Additionally, we've also seen capexes continue as this has played through, so which meant that credit growth has been extremely strong for the banking system within the entire credit growth at an overall financial perspective. As we look ahead, our expectation is cost of funds will catch up for the banks. On the flip side, whenever we see a pause in interest rates and there is a belief that the longer run interest rate will start to inch downwards, we believe that the NBFCs will start to benefit. On their advances portfolios, typically NBFCs have a fixed maturity kind of portfolio, which means repricing happens with a lag. So a lot of repricing will happen as we move ahead into FY24. So they will have a benefit of repricing that will play through. So our sense is you will start to see catch up in performance. Despite all of this, I think the earnings growth for a larger weightage within finance, that something like a Bajaj Finance has still delivered an 80% earnings growth in the first 9 months. We believe that will deliver a 60% earnings growth for FY23 as a whole. So earnings growth has not disappointed there. What has essentially happened is the names which were not there in this portfolio, particularly the public sector banks, some bit of corporate banks which were not there in this particular portfolio, monies have essentially flowed there and out of certain names. Our belief is that once we are through this period, people will start to refocus on what is the longer term delivery of return on equity. That in turn determines what is the growth that these entities can deliver from a more medium to long term perspective. And that is where the focus will again shift back to quality and growth. So a large degree of underperformance is due to the financial exposure. There is obviously some degree of it that has happened because of our chemical and auto exposure. Both of these are linked largely to what is happening on the global front, given the fact that the demand on the global side has gone through some bit of tepidness. What we are witnessing is destocking at a global level. That in turn has meant that earnings, particularly driven by volume growth being lackluster, coupled with margins coming under pressure, we've essentially seen earnings being tad bit lower than where they should have been while we were sitting in say December of 21 and estimating for what will play out for the fiscal year 23. So there has been a downward revision there. Having said that, structurally we believe that we are in a very good spot. There are strong tailwinds as far as manufacturing in India is concerned. Inquiries continue to remain strong. We continue to see capexes happen for these entities, which essentially points towards a future where they also expect acceleration in volumes that will happen whenever this issue settles down and you start to see restocking which happens on the global front. The third pocket is obviously our auto exposure. Again, we do not have any OEMs. We have an exposure through the auto ang space, where we've consciously stayed with the right side of the technology shift that we are witnessing globally. The move is there towards shifting away from ICE engines, more towards electric vehicle or hybrid. And we are exposed there in that particular space. What we witnessed again is that this is global demand, which has meant that any amount of variability in global vehicle sales, particularly of this pocket, has meant that there has been some delay in ramp up of campaigns. Having said that, what we've also witnessed similarly to the chemical space is order books have kept on increasing. So the order book has increased in this particular name from 10,000 crore to 23,000 crore as we stand today, which essentially points towards ramp up of delivery on this particular order book as we move into the fiscal year 24 and beyond. And as the global transition continues away from ICE and towards electric vehicle and hybrids. So going forward, our expectation is earnings start to accelerate from FY24. Volume growth starts to pick up, starting the end of fourth quarter, largely the first quarter. Government capex itself adds a fillip to that growth. So domestic growth starts to revive early on, volume growth in particular. Margins start to normalize. At some stage, we will see even exports starting to contribute. While more medium to long-term picture looks well placed, what we have to maneuver is the near short-term volatility, which is essentially emerging from cost of capital increases and the fact that as cost of capital goes up, there will be some degree of adjustment on demand that is anticipated to happen, which has led to destocking of inventory and which can mean global growth follows through with a lag. So that is the near-term volatility that we need to watch out for. From a risk point of view, clearly inflation is a monitorable out there. And if we have a good Rabi season, I think we are well poised then for volume growth as far as the domestic piece is concerned. And for the portfolio as a whole, we expect acceleration in earnings to happen from 24 and beyond 24 as well. So I will pause here and will be happy to take any questions that have come.
Thanks, Chetan. So we have a set of pre-submitted questions to start. I will just address these questions one by one. The first question goes as follows. So over the last 20 months or so, the Emerging Opportunities Fund was launched, and it has been close to 6 months now that the drawdowns have been paid by clients. What are the attributes in terms of what has worked well and what has dragged the portfolio as far as the stocks are concerned? And what are the corrective actions that are being taken in the portfolio is the first question.
Right, I was pointing out the biggest drag as far as EOP is concerned has been the entire financial exposure. And that drag is largely a function of monies moving away to pockets which were arithmetically cheap, where we were seeing normalization in ROEs, which has meant that monies have moved in that direction. While in our investment philosophy, we continue to focus on high quality businesses, the earnings delivery for the set of companies in our portfolio has not disappointed, but stock price performance has not been in line with earnings delivery, which we have experienced over so many years. So our view there is, when we look at that piece more closely, is that after this period of normalization, there are factors which will positively continue to add to earnings growth for the names that we have in the portfolio. Plus, there is a ceiling that gets created with the ROEs of those entities, which in turn means growth itself then cannot significantly exceed those ROEs for a length of time. Higher ROEs for our names essentially means the runway for growth is longer, and the focus will shift back here. So even within that pocket, what we have done is we've obviously taken some weights off where we believe that there can be some degree of pressure there, and we've increased weight in other names within that particular financial exposure. Second bit of issue is the chemical names. We have replaced certain names in that particular pocket as well. We've added a Naveen Fluorine to the portfolio to strengthen the chemical exposure, because we believe the runway for growth in Naveen is longer, given the capexes that they are doing currently and the new set of capexes that we expect from them. We've obviously added some degree of weight to something like a KEI Industries in the portfolio. The pharma bit itself has disappointed to some degree. So certain of our pharma names, be it on the healthcare pharma diagnostic space, Metropolis, which has come under pressure because of significant change in competitive intensity. So that has not delivered earnings in line with what we would have anticipated, while there is a fair degree of overhang on how those ROCs will shape up going forward because of increased competitive intensity. While our view there is that this competitive intensity cannot last forever, we are watching that exposure very closely, and we are seeing and taking corrective actions there as well. Similarly, I think Laurus was another name which has impacted performance, and there the issue has been, like I was highlighting, that certain pockets have witnessed destocking globally. So their API piece has essentially witnessed destocking, which has meant that earnings have been tad bit lower than what we would have expected in FY23. There has been some amount of revision downwards in 24. So we have replaced that exposure as well. So there are certain names which we've added to the portfolio. There are certain names where we've reduced weight. While doing this, the focus clearly has been to strengthen the portfolio more from a medium to long-term perspective, to add names where we believe the tailwind remains strong, managements remain capable of capturing that growth that is coming their way. A balance sheet remains sufficiently capitalized to capture that growth going forward. So those are the certain changes that we've made. Our belief is that as we see acceleration in earnings growth, you will start to see improvement that should ideally happen, and that has been a historical track record that performance has been a slave of earnings growth. What we witnessed in FY23 is, while earnings have grown, we have witnessed under performance being lackluster for the portfolio as a whole, which relatively makes it attractive as we stand at this point of time. So we are very much focused on market share gains by our companies. We are very much focused on earnings delivery of our companies. We are very much focused on quality of earnings. And while making changes, the few that we've made right now, there will obviously be some changes that we make as we move along. This is an ongoing exercise. So we continue to review this on an ongoing basis. But the base idea will still remain same. Are we strengthening the portfolio? Are we looking at these changes from a more medium to long-term opportunity that is available?
Thanks, Chetan. That's an interesting answer. So the next question is on the lines of the mid and small cap space, considering that the trend has been adverse for this segment in the last few years. What are the prospective opportunities as a segment that can be expected in the years to come?
So if you look at history, very clearly, there is a large degree of correlation between the growth rate for mid caps and small caps with the growth rate of the GDP. So as GDP accelerates, you see a lot more window that opens up for everyone to capture the pie. Our belief is that, and even what the numbers are put out by by the World Bank through the World Economic Outlook, very clearly India is in a bright spot as far as GDP growth is concerned from a more medium to long term. So their numbers too point towards acceleration in GDP growth. Whenever a GDP growth acceleration happens, it essentially opens up space for a lot of small caps and mid caps, and that provides them space to essentially grow. Having said that, while we have always remained market cap agnostic, our belief firmly is that any entity, whether it be mid cap or small cap, should have the character of high quality business run by high quality management and size of opportunity remaining big. And that should remain a focus. So even in the mid cap space, as the opportunity opens up with acceleration in growth, entities which become larger in size eventually are entities which have this metrics right. We've seen that play out in various names in our history. At ASK, we've seen that play out in names such as PI Industries. We've seen them play out in names such as Naveen Fluorine and SRF, even Bajaj Finance, for that matter, when we started buying into those names. You need to identify entities which have this character in place, which have these criterias in place. And as the GDP expands, these are the managements which will be able to capture a large part of this growth opportunity and accelerate earnings growth, and in turn become bigger entities as they move ahead, while strengthening processes and systems in place, which will play into a vicious cycle of further acceleration in growth as they move ahead into their own life cycle. So very clearly, last 4 or 5 years have been difficult as far as GDP growth is concerned, which has meant that larger, bigger entities which have more management bandwidth have been able to manage the situation much better than smaller and mid-cap entities in general. But if you look at in specificity, what you will notice is even a mid-cap or a small-cap name, if they had the right ingredient, they've still been able to cultivate growth in this difficult period and have emerged much more stronger in this difficult phase. And these are the entities which we believe will get bigger as growth accelerates.
Very interesting, Chetan. The next question is on the lines of capacity utilization. Question goes that if capacity utilization is tipping off, then why is corporate credit going down? What is the rationale behind it?
So if you look at what has played out is, so there are two things. The very near-term number and releases on corporate credit, you will see again leveraging that has started to happen at the corporate side. There was a phase, particularly when we were in the peak of COVID, there were worries on how the world would shape up in a post-pandemic era. The focus for all corporates was to essentially ensure that they significantly tighten their working capital so there aren't enough hits that come up, particularly on the debtor side. Similarly, corporates, particularly the larger borrowers, be it someone in the sector of steel or other commodities, which are large users of this particular capital, they also went through a period of deleveraging their balance sheet. So a classic example is steel, where you witnessed a very rapid increase in spreads and operating profits, and hence a large cash generation that started to happen. Most of these entities primarily focused on deleveraging. This was because of their own historical experience of the past, where a leveraged balance sheet in an adverse economic environment has put significant pressure on these names to deliver ROCs, to deliver earnings growth itself, and expand capacity in opportunities and areas which are more well poised from a medium to long term. So that experience has meant that as soon as capital or cash flow improved and was available, a lot of these entities started to deleverage their balance sheet. Given where we are at this point of time, what we witness is that those capexes continue. Today, there is some degree of sufficiency of cash flow which they are generating internally. Our view is a real acceleration in private capex will happen as you start to see further tightening of capacity utilization as growth and volume demand improves. FY23, like I was highlighting, has been a year where volume growth has been lackluster to some extent. Our expectation is that starts to improve from 24 onwards. Right now, a lot of capex is government driven, and government is taking the first step to accelerate capex. That in turn will put demand or derive demand in a lot of sectors and pockets, which will increase capacity utilization there, and which will mean that capexes start to happen even there. So the backdrop of the entire corporate deleveraging was tightening of working capital, deleveraging with these corporates were doing to strengthen their balance sheet. Going forward this year, we are witnessing a first leg of credit offtake happening, primarily because as working capital expanded, there was first leg of credit growth that happened. A second leg will essentially happen as private capex accelerates.
So yes, I think that answers the question on the expectations of where do we see the portfolio turning around in terms of performance. So next question is on the lines of certain stocks where clients have seen that they have been onboarded at higher valuations, and in terms of these stocks have faced headwinds in growth and margin, and at the same time are at the risk in terms of PE contraction. So examples that have been shared are on the lines of Dixon, Sona Comstar, Berger Paints, and so on. What is the take on such businesses?
So Dixon very clearly is a classic case where there is a strong tailwind. It is a clear beneficiary of manufacturing in India, and that tailwind still continues to remain there. What has happened in the interim is obviously the fact that they've undershot their guidance for the current fiscal year. So they started the year with a guidance of 16,500, 17,000 crore of revenue. By the end of Q3, they've revised that guidance down to 12,500 crore. There are various factors associated with that, which are also linked to the exposure of their customers to global demand and global growth, which has meant that they have also had to pare down their expectation of delivery because of what is happening globally. So very clearly, there has been a paring down of the revenue expectation of 23. While for 24, again, the guidance is higher. Having witnessed what we witnessed in this particular year, we have obviously become way more cautious. We are essentially looking at these names which are more closer lens, that we've been doing that for the last 3 to 4 months to 5 months, ever since the first warning on revenue happened. So we've kept them under close observation to see what we can do in those names. The derating as these names is a function of both the factors. One very clearly is the miss in earnings, and the fact that what was expected in terms of EPS for this year has essentially shifted out to the next year. Plus the fact that cost of capital itself has gone up. So that has also meant that there is a degree of derating that has happened. For a Sona Comstar, like I was mentioning in my comment, while the energy transition or the transition towards EVs and hybrid is clearly in place as far as global automotive is concerned, we have seen their order book increase from 10,000 to 23,000 crore. Again, from a very near-term point of view, it continues to remain exposed to two things. One is the global demand environment and outlook. Second is how commodity prices play through on their P&L. So we've seen some degree of impact there. In a Sona Comstar, what happened was the FY22 numbers were ahead of what we were expecting for them to deliver in 22. So they essentially delivered 23 numbers in 22. What was getting built is that acceleration continues in 23. There has obviously been disappointment there. Those numbers have shifted out, while order book has continued to increase. What needs to be taken cognizance of is the fact that these are customer related businesses. These are businesses which are more focused towards launch of new models, new vehicles on the new energy platform. And hence these campaigns are tied very closely with what these customers intend to do. The way to evaluate them from a more medium to long term perspective is, are they adding new products? They are adding new products. Are their order books expanding? They are. Order books have expanded significantly. Are they adding new customers for the same product? So they've got those pieces right. There has been some amount of postponement of the earnings growth that has happened. Our expectation is the next fiscal will see a lot of those campaigns which were essentially signed starting to roll off. There is some degree of urgency which is now there from even the traditional OEMs to launch EV vehicles and EV platforms. That essentially means there will, compared to their own historical ramp up phase, there might be a tad degree of faster ramp up that happens on these projects. And our expectation is that earnings growth will accelerate as we go ahead. And that in turn should translate into performance as far as Sona BLW is concerned. So this is largely on Dixon and Sona. Prabhu, what was the third stock?
It was Berger Paints.
So in Berger, it's a classic case where I think historically paints as a segment, what we've seen is that it's an industry which is a three-player industry. They have a high degree of pricing power in this particular industry. Having said that, a very sharp increase in input prices meant that most of these companies had to take a significant price increase in November of 21. That significant price increase essentially meant that there was volume pressure which built up because the capability or ability to absorb such large price increases is obviously limited. So you cannot absorb these price increases and still have volume growth. To their credit, despite this environment, they have, and despite the price increases that they've taken, they've still been able to deliver a single-digit kind of volume growth in this particular environment, while margins came under pressure because of the volatility on the raw material side. Now, every entity is different. The way they plan their inventory is different. So that has essentially meant that Asian Paints has seen normalization of margins in Q3. The expectation from Berger is that they will see that normalization in margin in Q4, and that is how their inventories are placed. From a more structural point of view, what is important to note is the fact that volume growth, which is tepid this year, is expected to accelerate as we move ahead. You will see absorption of higher prices that has happened. Most of these entities are in a situation where they will ideally, given that nothing happens more volatile or a sharp increase on the input cost, they would ideally not want to take price increases. The focus shifts back on growth. On this entire backdrop of what was happening on volume and margin, there is a narrative of new player entering into this particular pocket, uh, which has essentially meant that there is a view that competitive intensity for this space changes from where it was historically. What we are keeping a close eye on is the fact that what will be the go-to-market strategy for this new particular entrant. There have been certain efficiencies and modes which an Asian Paint or a Berger have built over a period of time. Certain examples are the fact that for an Asian Paint or a Berger, the dealer typically does not have to stock too much inventory, as their supply chains are robust enough to deliver those goods in 2 to 3 days period in case of Asian Paint. There is deliveries typically in the larger serviceable market which happen daily. So ROCs for dealers, distributors working with these companies is significantly higher, while margins optically may look lower. For a new entrant to build this kind of mode will obviously take its time. It will have a cost associated to it. They will have to incentivize the channel, because the channel will eventually want the ROC which they are getting by stocking paints for these companies or these leading paint names. So there is a narrative play as well that is happening, particularly on the paint industry. We are keeping a very close eye there to see what happens. So derating that we witnessed in paints in general is a function of three factors. One is obviously the margin pressure that we witnessed this year that we expect will reverse. So one factor out of that will reverse. Second factor is tepid volume growth that we expect also should start to reverse as we look ahead. A third factor is obviously expectation of increase in competitive intensity. And that is something which we are monitoring closely to see how the new entrant plays in the marketplace. We will look at their go-to-market strategy. We will look at how they expand in the marketplace in general, and to see how they execute, how well they execute today in the marketplace. Fourth factor is obviously cost of capital. So that is something which is not in our control. That is something which we believe, like I've highlighted, we'll see a plateau will start to come down. So that is something that will get addressed as we move along as far as global macros are concerned. So it's a combination of these four factors, out of which two controllable factors we believe start to improve as we move ahead. The third factor we'll have to monitor very closely.
Thanks for the extensive answer, Chetan. A final question on the portfolio. In line with the financial year 2024, what is the EPS expectation in the portfolio? In the context of the monsoon, is weaker this year? How do we see it affecting the portfolio? And on account of these aspects, what kind of cash allocation are we looking to maintain in the portfolio?
So like I was showing you in this particular slide, the EPS growth for FY24 is 30% compared to the EPS of FY23. So we expect a 30% growth for the EPS for the portfolio as a whole. As far as the entire monsoon bit is concerned, very clearly what we've highlighted, or I've highlighted in my conversation, is what we need to watch is two things. One is clearly what happens to Rabi output. We are in a very crucial phase as far as Rabi output is concerned. We are witnessing news flows that is coming in that temperatures are somewhere 10 to 11 degrees higher than normal, particularly in the key northern states for the Rabi crop. So we'll have to first keep a very close eye on what happens to the Rabi crop itself. Having said that, as far as Kharif is concerned, while there are articles which mention that La Nina is over and El Nino is here, what we need to take cognizant is the fact that last few years have been essentially years of very patchy rainfall. While on the whole, you see a normal rainfall, the distribution has been significantly patchy. Even within that distribution, there have been periods where there is excess rainfall in a span of very short period, which has impacted output of the agri space itself. So what we witnessed at the end of Kharif, and a large degree of reason for the slowdown that you're witnessing in rural, is the fact that till September end, the Kharif crop was significantly better across the country. In the first 20 days of October, you saw significantly higher rains in the entire belt of UP, MP, Western Maharashtra, Rajasthan, some parts of Haryana, which essentially meant that there was crop damage which happened, yield came under pressure, which in turn impacted incomes and the entire situation of volume growth that we are witnessing at this point of time. So while on a holistic number, it appears to be that last few years were good in terms of monsoon. Last few years had their own challenges where rain or spatial distribution wasn't adequate or nice. You had pockets where there was significantly higher rainfall in a short span of time, which impacted output. So going forward, we'll obviously have to closely monitor what happens to the Kharif crop, which comes up, and how monsoon behaves in that particular point of time. I think what has happened in the last few years, so be it last 7-8 years, largely is because of climate change. We've also started to witness some amount of shift in cropping patterns. We've started to witness rainfall getting ideally delayed by 15 to 20 days each year. And there have been advisories which have been going out to farmers from the government and government agencies, wherein the focus clearly is to get varieties of seeds in which can now deal with this volatile climatic condition, shorter duration crops, look at cropping at the right time and not rely more on what historically used to happen in terms of rainfall. So these will be changes and advisories which governments will give out from time to time. But climate change is a clear worry. And if we see very adverse Kharif crop, then that will obviously have ramification in the way we expect volume growth to behave in FY24. So there are two legs to this. The first leg is the very immediate leg, which is the Rabi crop itself. And that then follows up with Kharif crop, where we'll keep an eye on how things shape up. Having said that, agri as a percentage of GDP still is small. So very clearly, if the monsoon is bad, it will essentially mean higher food prices. It will essentially mean inflation remains sticky for some more time. It will essentially mean cost of capital remains higher for a certain degree of time. While manufacturing and services will continue to deliver the growth, there will obviously be shave off of growth that can happen if the conditions on the climate side are quite adverse as we go ahead. So that is how we see this behaving. So keeping a close tab there.
Right, Chetan, that was an excellent answer. So that rounds up the questions for the session today, and we can conclude the session. I would like to take an opportunity to thank all the participants and conclude the session for today. For your information, we are conducting this session on a quarterly basis. Going ahead, you will see more of these knowledge series surrounding our products on a regular basis from our portfolio managers. So with this, I end the session today. Thank you all for participation. Good day.
Thank you everyone for joining in. Have a good evening. Thank you so much.